before you even start going shopping for a home, real estate agents will allow you to even look at the home until you have what's called a pre-qualification letter. So this is the first step in the home buying process, is to get pre-qualified. In the previous video, I'll show you what to prepare for, but pre-qualification is actually the very first step. So the first thing to do in getting pre-qualified for a home is, one, you got to find a mortgage officer. So you want to find a mortgage loan originator. Now, a mortgage loan originator or a loan officer is someone who's going to be able to help you get pre-qualified. They're actually going to take what's called the application, right? So they're going to do the application, and in the application, they're going to determine, they're going to, of course, run your credit. They're going to ask about your current your income and your debt that you have right now, to kind of determine what your debt to income ratio is. You find if you're running credit for both you and your spouse, or you just qualifying, or is just one person qualifying for the home. So they're going to run that credit application to determine what you're qualified for as far as the budget. The next thing they're going to give to you is they're going to present the different types of mortgage options. Mortgage products, essentially, right? So there's basically two types of mortgage products. There are the government ones, which means these loan products are backed by the government, secured by the government, and then there are conventional. The government ones are the ones that are going to have the low to no down payment, as I described in the previous video, right? So the low down payment is like 5-10% down payment. And then because, the lower the down payment, the more risky the loan is. And so that's why the government will back it. So if you fail to pay on that loan, then the government is going to help the bank out a little bit that you borrowed from. Or there are the options where you can borrow the down payment. So you essentially have two liens on the property. You got the mortgage lien and you got the down payment lien, essentially, that you had to borrow from for that. Now, when you have two types of mortgages, then that limits your options as far as that property and what you can do with it. So depending on what type of mortgage products you'll go with, then they'll share with you the types of homes that will be available. Certain types of homes don't qualify under certain mortgage products, right? And so it's very important to understand, once depending on what you qualify for, is the type of home that you're going to be able to get, right? So most single family homes are available, but there's also taking consideration, the location, the type of community that's there, and what they're designated for, right? So there's those options that you have to consider, right? And then also one thing to be aware of when you're pre-qualified, and this kind of goes into shopping as well, is that when you start shopping for a home, there's also this HOA fee, right? That goes on top of the mortgage payment. So an HOA fee is something that covers, if that neighborhood has a park or a basketball court or a swimming pool or a recreation center, or, that neighborhood provides maintenance for the lawns and so forth, right? So there is a HOA that helps pay for all of that maintenance and for that recreational activity. And that's called the Homeowners Association, that you have to pay towards as well, right? Now, if you decide to go with the government funding type product, there's also going to be what's called mortgage insurance. And mortgage insurance is because you have less than, the conventional product is, greater than a 20% down payment. Then they consider, like I said, a more risky type loan product. And so in order to protect the company that's lending you that's financing the loan for you, you're gonna have to pay what's called mortgage insurance. So besides just what they call PITI, which is principal, interest, taxes, and insurance, there's another insurance that's gonna have to be paid, which is the mortgage insurance. And you have to pay that mortgage insurance until your your loan is less than 80% of the value of the home, and then you can go ahead and remove the mortgage insurance off. But if the loan is more than 80% of the value of the home, then you have to maintain that mortgage insurance, right? So that's a critical element as far as determining between a government type product or a conventional type product, or if you're putting less than 20% down on a particular home, because then you're gonna have to pay that mortgage insurance, which is gonna eat up at your budget as far as what you want to qualify for. So just be sure to keep that in mind. So then once you have all that, then the lender's gonna draw up what's called the pre-qualification letter. And that pre-qualification letter is simply the ticket that allows you to go shopping for a home.